Okay, we're ready to start studying about receivables. So this is a lecture that kind of gives you an idea about some of the issues that surround the receivables and just a general overview of what the accounting challenges are relating to them. Okay, first, there's an expense related to receivables that is a bad debt that you don't realize you're having. Usually when you extend credit to customers, there's just a very strong likelihood that some of them will not pay, but you don't know which ones it is, of course, or you wouldn't extend credit to those customers. And so the companies that use accounts receivable to record the sales that they don't collect, when they're going to collect the payment the next month or in the next couple of months from their customers, they do that in good faith, thinking the customer will pay. But everyone knows that some customers will not pay. And so what you do is you estimate what might be the default rate, basically. And so when you look at your history, you kind of can get an idea what percentage of your customers won't pay their balance. You can use that as your bad debt percentage, or you can just look at all the accounts and see how old they are and measure those old accounts as not as collectible as the fresher ones. And so that's why there's multiple ways to calculate how much the bad debt is. But in either case, you're supposed to, by GAAP rules, you're supposed to estimate a part of your receivables as uncollectible and make an allowance account for the expected loss from that. Okay, so what we're going to do is we're just going to wade through some of those what happens when those transactions happen. First, when you make a sale, if it's not a cash sale, you would always debit accounts receivable and you have a subsidiary ledger of accounts receivable that shows all the customers' names that owe you. And so you're debiting the accounts receivable to that customer and you're crediting the sales revenue. And of course, we know you have that twin entry where you record the cost at that time, but we're just going to focus on the receivable part in this chapter. Okay, so then when the customer pays part of that balance, you know how it works. It's the same that we learned at the very beginning of the course. We debit cash, we credit the accounts receivable for that customer. So their balance just keeps going down every time they make a payment. But what happens is we're going to estimate an amount that might not be collectible from someone, and we don't know who it is, so we can't attribute it to a certain person's account. So we build this allowance account by making a journal entry at the end of the accounting period that debits bad debt expense and credits the allowance for doubtful accounts, which is a contra asset account. There's also other names you could call it. You could call it the allowance for bad debts. You could call it for the allowance for uncollectible accounts, but most textbooks call it allowance for doubtful accounts, or commonly known as the ADA account. The bad debt expense also has multiple names. It could be called uncollectible accounts expense, could be called doubtful accounts expense, or bad debt expense. But in all three cases, it says the word expense. And in all three cases, it's very clear that it's the account that's tied to the allowance. So on your balance sheet, what you would have is you have the entry for accounts receivable and the amount that the full amount of the accounts receivable that's outstanding. And then below that, you would have less the allowance for doubtful accounts. And that would be the contra offset, so that you'd wind up with a net realizable value for the accounts receivable. And sometimes they abbreviate that with an NRV. And okay, then when you go along and you actually write off a bad debt, like you see someone's not going to pay, they send you a paper showing that they're filing bankruptcy, or they just it's outstanding for years and years and they never pay, so you decide to write it off. Well, for whatever reason, you have to have some basis for writing off an accounts receivable. But if you do have a good legitimate reason for writing it off, then rather than showing it as a bad debt at that point, since you've already been estimating bad debt, when you write off one under the allowance method, you debit the allowance account instead of bad debt expense at that point. So you debit the allowance account and you credit that customer's accounts receivable, because you're trying to take that accounts receivable off the book so you don't have to keep staring at it. So you credit their accounts receivable as if they had paid, because you're not going to keep billing them once you write it off. So the effect of that on the net realizable value is none. You see, before we did the write-off, we had accounts receivable of 200,000 and an allowance of 10, and that brought us to a net realizable value of 190. So if we have a bad debt come along for $9,000, what that does is it makes a debit to the allowance account, which now makes the allowance account only be $1,000, and it makes a credit to accounts receivable, which lowers the balance from 200 down to 191. So when you look at your balance sheet after that adjustment, you wind up with an accounts receivable of 191, allowance of 1, for a net realizable value still of 190,000. That's because you didn't actually change anything, because you had already assumed these accounts are going to be bad, and you didn't make it any different by your write-off. Okay, now sometimes it seems like it happens more often than not. A lot of times when you write off a bad debt, you just wait and wait and wait for them to pay, and they don't do it, and you finally just stop billing them and write off their account. And then sometimes, very often I've seen the customer notices that they're not getting a bill from you anymore, and they come up or call you up or come in your office and they say, "Oh, I noticed you're not billing me. I'm going to pay you. Please just give me a little time. I'll get you your money." So they're like, okay. The business, usually they don't come with all the money and say, here's all of the money I owed you. Instead, they say, "Let me pay you this little bitty portion of what I owe you." And so whenever that happens, you have to reinstate the accounts receivable. In other words, you have to reverse your write-off. So if someone owed you this $9,000 and it was bad, then they came back and said, "Let me just give you $90 of the $9,000 and I'll pay you until I get it paid off every month." So they come back with that and you're like, "Oh, thank you." And you're trying to be so gracious about it, but you're like, that's a lot of trouble and they're probably never going to pay me anymore after this $90. But nonetheless, you have to, if you're going to put them back into current status or collectible status, you need to go ahead and reinstate the entire accounts receivable. So you would debit the accounts receivable, their account for $9,000. I named them the unworthy company. And then you would credit allowance, because you're just reversing your write-off. And then you would post the payment they made, and so if they brought you $90, you would debit cash $90 and credit accounts receivable unworthy company for $90. In this example, I had given them a little more credit for bringing us a little more of the money and said, "Well, what if they brought you $2,000? So if they brought you $2,000, that would reduce their accounts receivable down, whereas they only owed you $7,000 now. But it's just like any other collection. It's just whatever they give you in cash, you just post it, because now you have their account back on your books. Okay. Okay, now we talked about the fact that we're going to make a journal entry back here to debit bad debts and credit allowance account, but we didn't say how we're going to calculate that. So let's go back to that now. There's two methods for calculating the bad debt expense and the corresponding entry to allowance for doubtfuls. And that is the percentage of sales method or the analysis of receivables. So some people call that analysis of receivables method the balance sheet method. And you could think of the percentage of sales as the income statement method, because it's just based on credit sales. So what you do for the percentage of sales, you would have to look at your historical records to see what the write-offs normally were, so you could come up with a percentage of your accounts that are probably bad. That percentage would be applied to whatever credit sales you made this period. So you would add the amount you would add to the ADA account is the estimate of the bad debt, the estimated bad debt percentage times this year's credit sales. So it doesn't matter what's already in the ADA account. It doesn't matter anything. The only thing that matters is the fact, or how old the accounts or anything. The only thing that matters is sales for that year that are credit sales. and the percentage that's going to be bad. So the problem's always going to have to give you, we're not going to be able to manufacture a percentage that's bad of accounts. So the problem will have to give that to you, and then they will let you see the credit sales for the year. Okay, so that's one way. That's actually the easiest way, is just to use the percentage of sales, because it is what it sounds like. Credit sales times this percentage that the problem will have to give you. Then the other method is the receivables analysis would be, you look at the outstanding balance of for the period to determine how much of the balance is past due, presuming that collectability diminishes as time passes. So if it's very old, you're not likely to get it. So you could do what's called an aging of the accounts receivable, where you make a schedule of how much of our accounts receivable is past due by 30 days, by 60 days, by 90 days, more than a year. You can do any levels of it and discount it based on how much you consider collectible at this point. And so then if you see how much of those old accounts seems to be bad, you could just say, we calculated this amount of the accounts receivable that we think is bad, and adjust your ADA account to the amount that you expect is probably uncollectible, the total amount based on the aging that is uncollectible. So to adjust the balance, you take the balance of each aging class times this percentage that you're deeming it to be collectible, and then that summary total would be the amount that you want the ADA account to equal. So for this one, you have to look at the ADA account to see what is its balance. The allowance for doubtful, or ADA account, is a credit balance account because it's a contra asset. So it's going to have a credit balance if everything's going right. If it goes into a debit balance, it means that your percentages that you're using as uncollectible are probably too low. So you need to adjust your percentages if it keeps going into the debit balance. But I mean, one time's not a big deal. But if it continually lingers into the debit balance as the year goes on, then you probably have your percentages wrong and you need to revamp. But for our purposes in this class, they will give you the percentages that you're going to use. They will tell you how much of the accounts is deemed to be uncollectible. So you'll know what to adjust it to. So if you're using the balance sheet approach or this analysis of the receivables and aging, then you would adjust the ADA account from wherever it is. Whatever the balance is in there, you adjust it to a credit balance of whatever the amount is that you think is uncollectible. Okay. And so it's not related to sales at all. It's only about the balances and the amount that's in the T account for ADA, or the general ledger account, if you want to think of it that way. I just always think of it as a T account, even though I know it's like a computerized register that shows the ledger activity. Okay, all right, so then we're going to work some of these exercises from the Openstax. And this is, let's see which chapter I'm in. Let's look at the bottom of it. Hang in there. This is chapter 9 in the Openstax Financial. So it's the volume 1 of the Principles of Accounting. And so the first problem is EA6. Millennium Associates records bad debt using the allowance balance sheet method. They recorded $299,420 in accounts receivable for the year and $773,270 in credit sales. The uncollectible percentage is 3.2%. On November 22nd, Millennial identifies one uncollectible account from Angels Hardware in the amount of $3,650. On December 18th, Angels Hardware unexpectedly pays its account in full. So they want us to give them the journal entries for these 3 different transactions. The year-end adjustment for the bad debt that we just discussed. I got some descriptions on here, so it's a 3-line entry. It's not a compound. So we're going to debit bad debt expense. They've got cents on it. I'm going to lose the cents because I usually make journal entries in whole dollars. So let's just go for that. $9,581, which is just $299,420 times the 3.2% that they said that they're assuming is uncollectible of the balance sheet account called accounts receivable. So that's usually they only give you one straight percentage whenever they're using the sales method, but this one happens to have a straight percentage that they use on their entire accounts receivable balance. So you just, if they give you that and they say they're using the balance sheet approach, you just take the total of accounts receivable and multiply it times that percentage to determine your bad debt expense. Okay, this only works for this one because there was no beginning balance in the ADA account. If there had been, you would adjust to the $9,581. All right, so that's the first entry. The second one says November 22nd, the identification entry. Let's see what we got. This is where you're writing off a certain customer's account as bad. So this is Angel's Hardware. So writing it off does not mean a debit to bad debt expense. It means a debit to the allowance account. So we wrote off the balance, so we won't be sending the bill anymore. Then a few days later, on December 18th, almost a month later, that this Angel Hardware comes up and gives the payment. So we have to then reinstate the account, just as we mentioned in the lecture notes, before we can even post the payment. So we reinstate the account by reversing our write-off, debiting the accounts receivable to Angel, and crediting the allowance account, which totally wipes out our write-off. And then we can post the fact that Angel brought us the money. So we just record it as any other payment, debit to cash, credit to the accounts receivable. All right, so EA7 is the next one will work. This one says the following accounts receivable information pertains to Marshall Inc. These are the past due amounts and what's the uncollectible percentage of either one. This is what's called an aging schedule. And so what you do is just multiply each of these receivable amounts by the uncollectible percentage, which we're doing right here. We're just going to put this in this format so we can. And then when you multiply 84,550, I'm sorry, I have to get rid of these zeros because it's not customary to use zeros in our journal entries. Okay. We would multiply those across 84,550 times 8%, 32,230 times 16%. I'm rounding. And 22,170 times 37%. So then our total would just be the total of these three different levels of accounts receivable. Just getting rid of the cents. Total estimated uncollectible bad debt is $20,124. Now, if you had a balance in your ADA account, you'd have to adjust it to equal to $20,124. But since they have not given us a balance for our ADA account, we're assuming the balance was zero, so we post the entire amount of the bad debt to debit it to it as a debit to bad debt expense and a credit to allowance for doubtfuls. Okay. All right. Let's see what else we got. We have just one more that's got several transactions into these, and then we'll talk about one more topic on this chapter. PA4. This is JARS Plus. They recorded $861,430 in credit sales for the year and $488 in accounts receivable. The uncollectible percentage is 2.3% for the income statement method and 3.6% for the balance sheet method. So they're saying for the income statement approach, they're going to take 2.3% of credit sales, and that's going to be their bad debt. And for the balance sheet approach, they're going to take 3.6% of the accounts receivable, and that will be the amount that should be shown as the bad debt in the ADA account. Okay, so the first thing we'll do, we'll record the year-end adjustment for 2018 using the income statement method, assuming no balance in the ADA. So we're going to debit bad debt expense. We're going to credit allowance for doubtful accounts. And we're doing it to the tune of credit sales times 2.3%. I'm not going to round because it's going to take me a long time to do that if I did. But you see, I could have just put 19,813 and that would have been fine. All right, then the second one, record the year-end adjusting entry for the bad debt using the balance sheet method. The balance sheet method takes the accounts receivable of 488 and multiplies it times the 3.6. And that is the amount they're going to record as bad debt. If you had a balance in the ADA account, you would have to adjust it to the 17,568 rather than just posting the entire amount to bad debt and to the allowance account. All right, C, assume there was a previous balance in the allowance for doubtful accounts of 10,200. So record the year-end entry for the bad debt using the income statement method, and then the entry using the balance sheet. So we're going to do the income statement approach. 19,812, still exactly the same way, except for we should do it without the pennies, but we're not. And then on the balance sheet approach, rather than showing the whole 17,568 as bad debt, we're going to adjust, because the balance in the ADA account for item C was, this is not a normal balance, a debit balance of 10,200. So we have to clear that debit out and then leave a balance of 19,812. So we would have to credit the account for the 10,220 to get it back into the positive, and also credit it for the amount of this calculation we made, which was the 17,568. So that's why it's so large, the adjustment. We're trying to bring the ADA balance to the correct number with the balance sheet approach. Okay, now D, assume there was a previous credit balance in the ADA account of 5,470. So this is a normal balance for ADA, 5,470. So what would be the two entries? Under the income statement method, it would still be exactly the same, because we don't take into account the ADA balance when we adjust for using the income statement method. We only use credit sales and the bad debt percent. But for the balance sheet approach, we look at it and we adjust our ADA account to the correct number. So we want the ADA account to equal this 17,568. And this problem told us that it already had a balance in it of 5,470. So that's why we're only crediting allowance for doubtfuls for 12,098, and we debit bad debt expense for that same amount. Okay, so that's kind of what we're going to deal with on accounts receivable and bad debts. Then we have something else in this chapter. They talk about notes receivable, and not all of this is in the chapter, but it's things I think you need to understand. So we'll just cover it just slightly, and I might add some questions to the test bank that include this kind of issue. If not, at least you can say that you have been exposed to some extent to this. I have this little trick about the days of the month. You need, in order to be able to calculate a due date or interest calculations, you need to know how many days there are in each month. So there's a lot of people I know that use the knuckle trick. And for some reason, I never got that knuckle trick when I was growing up. So you're supposed to be able to tell how many days there are a month by counting them off on your hand with the knuckles and all, but that never worked for me. So I had to come up with something else. And my way says there's 31 days in every other month. If you start on January with the 31, and then you reset on August. And the reason I'm having to do that is because July and August both have 31 days. So that's why I have to reset on when school starts in August. But anyway, every month has 31 days, except every other month has 31 days. If you use January starting place and then August is the next starting place. And then the off month has 30 days with the exception of February. February has 28 days unless the problem specifically says that it's leap year or that it's 29 days in February. Okay, so every other month is 30 and 31, starting with January being 31, and then August is also 31 starting over. Okay, so let's assume we have this $40,000 note. It's issued on April 15th. It's a 6% note that lasts for 90 days or 3 months. So 6% is talking about the rate, the annual rate. So when you're calculating interest, you have to multiply whatever the face amount is by your interest rate, that's the annual rate, and then prorate it by the number of days this note has. So that's something else you have to remember. So let's look at this. Let's try to figure out the due date first. If it's April 15th, we're going to calculate what the due date is on the note if it's a 90-day note. Now, the easy thing to do that would be wrong would be to just go 3 months from April 15th. Let's see. So it's probably April, May, June, July. Hey, it's 3 months. It's probably July 15th. What is it? No. It's July 14th. And let me show you why. In April, if you issued the note on the 15th, on the 16th would be when it was 1 day. It had been 1 day, right? So in April has 30 days in it because here we went. January has 31, then February doesn't. It's January and then February. March has 31, April doesn't. May has 31, June doesn't. July has 31, right? So March has 31, so April does not, right? April does not have 31 days, it has 30. So 30 days, and you subtract the 15th, which is the day that thing was issued, and that leaves you 15 days, 15 remaining days that are the note's gonna expire, 15 days worth in April. And then there are 31 days in May, there are 30 days in June. So then let's just calculate how many days do we have at this point. We're trying to get 90 days. We have the April days, the May days, and the June days. 15 plus 31 is 46, and 30 added to that is 76. So we need 14 more days to get to our 90 days. And that's why July 14th is the due date. Okay. Then the maturity value. We got a $40,000 note and it's at 6%. So if it were outstanding for an entire year, then it would be 40,000 times 6% would be the whole amount of the interest. But this one is not outstanding for a whole year. It's only outstanding for 3 months of the year. So if it were outstanding for the whole year, it would have been 40,000 times 6%, which is 24,000, right? I mean, 2,400, sorry. $2,400 is the annual interest, but this is only for 3 months. So we multiply by 3 months to divide it by 12 months and then multiply by 3, or you do it by the days, but it's better to do it by the month. Most of the time, we're going to come to a clean, even number if we go by the months instead. So we're going to have 40,000 times 6% times 3/12. And that's the 90 days. So the maturity value is 40,600. The original 40,000 plus the interest is going to be due at the end. That's the maturity value. So entry to record it. We would, at the time of issuance, usually you could loan somebody a money or you could loan another company money. And in that case, you'd debit note receivable, you credit cash. Or most likely what would happen, if you had accounts receivable that the customer wasn't paying, you could say, you know, I can get this, I can make this right where we can continue doing business by just converting this to an interest-bearing account, accounts receivable, which would be a notes receivable. And so the customer might say yes, so because they don't want to stop doing business with you, and they don't want you to turn them over to collections. So if that happens, you would record your note receivable by crediting that customer's accounts receivable and debiting note receivable, indicating that you change it to an interest-bearing note. So then when you receive the cash, you would debit cash for the 40,600 for the maturity value. You would credit note receivable for 40,000, and you'd credit the interest revenue for the 600. We're going to ignore supplement A, which is the direct write-off method, because it's not permissible for GAAP rules, and it's not actually used for most people's business anyway. So the best thing to do is we're just not going to spend our time on direct write-offs. And then you do need to concentrate on the presentation of the receivables in the balance sheet. Especially the fact that it shows the net realizable receivables by showing the accounts receivable and the allowance account to come to a net number for how much the receivables are probably worth at this point. Okay, and then there's the link for the Openstax to get to that textbook and end of chapter materials. All right.